9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Let's get to your top stories today. Stocks across the Asia-Pacific jumping after cooler than expected U.S. inflation and also a rebound in tech. Now, oil prices stabilizing as President Trump backs off on his proposed 20% Hormuz levy.
Memory chip maker CXMT reveals plans to raise almost $10 billion in what's shaping up to be China's biggest IPO in years.
Also on the program, Bloomberg learns that DeepSeek is laying the groundwork for its own market debut to bankroll its ambitious expansion.
And Beijing releases its latest economic numbers at the top of the next hour. Analysts expecting GDP growth to come in short of the government's official goal. All right. It was that U.S. CPI print, softer figures, that really is lifting the mood across Asia here today. And I think it really did kind of lift the mood and relieve a lot of pressure for Kevin Warsh, too, during that testimony overnight.
Yes.
Yes.
You probably sense the optionality in my tone, because he did keep the options open that, they're not done with battling inflation.
Mission not accomplished.
They remain committed to it. But at least we can take July off the table for now.
Yes.
Look at pricing. We've gone from about 43%. We're now to 18% probability on that. Oil prices do remain, of course, fairly elevated still, despite the other U-turn on the Strait of Hormuz, which we'll get to in a moment. But yes, suffice to say, the bulls are out, and it's providing this platform for chips, SK Hynix, and the like, to really see this broad-based rally we're seeing today, this Wednesday.
Yeah, and it really gives more time. I mean, the news about CXMT now preparing for this IPO, is that going to be the catalyst for Chinese stocks to really regain that momentum once again? Certainly, we're seeing some of those flows heading that way as we enter into the second half and the third quarter. So certainly a lot of interest in that front. But at least when it comes to the inflation story today, it seems like it is a little bit better than what we thought maybe 24 hours ago, right? Yes, they are maybe a bit stale, but the fact that you have this U-turn from President Trump about these 20% levies on the Strait of Hormuz, that also lowers the temperature. You have that taco trade coming back into markets again.
It does, and I think he did allude to the fact that when he consulted with his allies in the Gulf, they preferred to do it a different way. So I think he's backing off as far as that was concerned. And I think when you look at the inflation figures, just to also mention that, and you're looking at a picture, of course, of a softer U.S. dollar for the very first time in 6 years, right? Month-on-month inflation, led by the drop in energy prices, actually dipped below zero.
And you hear the commentary from Kevin Warsh, and it was interesting that he was, in some ways, hinting. I would say hinting at a bit of his hawkish side. That's what some of the analysts were saying when they were interpreting the commentary about, what he talked about and how to fight inflation and really bring it back to that 2% target, which the Fed has missed for several years now. And here's what he said, right? When he talked about, really, it wasn't a clear signal that the Fed was ready to hike, but it was the closest we've heard yet that they could.
If we get policy right, and I can assure you we will, the inflation surge of the last 5 years will be a thing of the past. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability.
So that was the Kevin Warsh sort of testimony there as well. In the meantime, when it comes to war in Iran, U.S. forces have reimposed a naval blockade and launched a new wave of strikes on Iran. And President Trump is also threatening further attacks in coming days unless Tehran comes to the negotiating table.
Do you anticipate that the strikes we're seeing this week against Iran will expand? Are you considering hitting energy targets or other locations inside of Iran?
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them, because next week comes the power plants. Next week comes the bridges.
So perhaps the tone there does explain why, despite this sort of pullback in the U-turn on the levy, oil prices remain to the upside. But again, we have to emphasize that when you look at pricing and risk today, it's all guns blazing for bulls, right? Whether that's A50 futures going into the session today. You look at how Korea is doing 6% to the upside. SK Hynix up 11%.
Wow.
Taiwan is coming online. Japan is also doing quite well. We should also mention we're going to get a lot of data coming out of China today. So that's also a very big component to trading today. Everything from new home prices. We've mentioned growth, activity numbers. And of course, this massive listings we'll get to in a moment. And also, we do have a 30-year bond sale today taking place.
The key thing to watch, I think, for the data dump is that, it seems like we're reached a bit of a turning point in the economy where maybe exports are no longer able to offset the drag on the domestic economy anymore. And that's what the Bloomberg Economics is projecting, that maybe we might actually fall short of that target here of 4.5% to 5%. 4.4 is what they're expecting.
Yeah.
Consensus, I believe, is around the lower end of that target. So certainly that's one thing to watch about where the momentum is in this economy moving forward here. But let's talk about the main story here when it comes to the Strait of Hormuz, this U-turn from the president here to really just walk back away from the threats that he said yesterday about 20% tolls on the Strait of Hormuz. Let's bring in our Bloomberg editor, John Herskovits now. John, really just tell us why the U-turn and what does it mean for now?
Sure. I mean, once Trump proposed this, the pushback was immediate and it was really big. We saw the UN IMO saying this goes against international law. The idea of imposing fees on the transport, this is against U.S. policy. Such a move would have increased oil prices. Trump heard from friends and foes alike, especially allies in the Gulf, that this was not something he wanted to see. So the pushback was really strong. And Trump reversed course within about 24 hours after making the announcement, saying that he had spoken with Gulf states and they recommended instead an investment in the U.S. as an alternative. Not many details in this. It seems like perhaps this may have been a way to save face and do the U-turn. But, it was a pretty bold move, which really had a lot of resistance from so many fronts on the idea of imposing fees for ships transiting the Gulf.
Yeah, and you got to wonder whether this, the financial implications of these investments into the U.S., whether that was the final objective. It's similar, really, to how the tariffs are being used for negotiate. Anyway, I'm opening a can of worms here. But, I mean, discuss for us, then, the risks to these seemingly changing announcements day to day and what the political difficulties are for the president as the big picture here.
Sure. Yeah, I think what we're likely seeing, we've seen on one front an escalation on the economic pressure on Iran. So we have the naval blockade that went into place. A few days ago, we had the end of waivers for Iranian oil exports. So in turning the screws on Iran, trying to make it more difficult for them to refill their coffers. The one thing to worry about is an escalation on the military front. Trump made threats to go after civilian infrastructure. He's made these threats before. There have been talk that such strikes on power plants, desalination plants would constitute war crimes. We haven't seen these attacks on these types of infrastructure carried out, but we may see the U.S. going beyond what it has struck over the past few days to hit a wider array of targets within Iran, perhaps maybe going after the nuclear program again or something else. If the U.S. escalates, we may see an escalation on the part of Iran. This would put more Gulf states at risk. This would increase the risk for shipping, and it increases the risk for the confrontation just getting worse. So, that's what could happen in the coming days. We're still waiting from U.S. Central Command to see what was hit in the latest wave of strikes. We should get an announcement from them in the next hour or so.
John, thank you. Our editor, John Herskovits, there joining us out of Tokyo with the latest. Let's get to another top story in China now. Its largest memory chip maker, CXMT, is seeking to raise a near record amount in its upcoming Shanghai Starboard IPO. It's the latest in a string of semiconductor companies seeking to raise capital amid the AI spending boom globally.
Yeah, for a closer look at the terms of the deal, what we know so far ahead of that massive listing, possibly over the next 2 or 3 weeks or so. Stephen Engel, our Chief North Asia correspondent, is here to talk us through what we know so far about the offering here of CXMT.
It looks like it's going to be a pretty big listing. It was just last Friday when I was sitting in for you guys here on the China Show. I was talking about a valuation of upwards of $4.3 billion. Now, all of a sudden, it's $9.8 billion. If you look at the pricing, the size of the offering, and if then also take into account the maximum possibility with over-allotment option, we're looking at $9.8 billion. We have not seen an IPO like that in the domestic markets since Ag Bank of China in 2010, which was $10 billion. It would also be the second biggest IPO in Asia after LG Energy Solution, the battery maker in Korea, in 2022. That was $10.8 billion. So we're approaching that $10 billion figure for Changxin memory technology. They don't call it that anymore, CXMT. Again, this is probably Beijing's best chance at breaking the big monopoly that the three big memory players have, Samsung, SK Hynix, and of course Micron, and also maybe Beijing's best bet to kind of legitimize, if you will, their domestic ambitions to be self-sufficient in this particular field in memory, which of course there's severe bottlenecks in memory right now, especially with high bandwidth memory that goes into the AI data centers and the like. So again, this is going to be a good litmus test, if you will, for Beijing.
Another name that's floating around, DeepSeek, could also be listing in China this year. What do we know at this point?
Well, we're hearing from sources that they've begun preparations for a listing possibly by the end of this year. This is a company that has been doing a number of different financing rounds. They just completed last month a $7 billion financing round with lead investors like Tencent and CATL. And these sources are also saying ahead of that IPO, if it does happen, they're looking for another tapping of the private markets, more money to spend at AI compute. We've heard senior managers talk to investors about the need to build out its high quality research and development in AI for its large language models ahead of any short-term commercialization. But again, you're going to have to start seeing in China as well, investors go, all right, when's the bottom line going to be prioritized? But it doesn't look like it is right now. They are going to be likely tapping, while the equity markets and the private markets are still dishing out the money, they're going to tap it.
Steve, thanks. Our Chief North Asia correspondent, Stephen Engel, there with the latest still ahead. We're talking about, well, South Korea, what's been going on there, right? Navigating this volatility around stocks and really where the market has peaked or not. We have HSBC's head of Asia Pacific equity strategy, Herald van der Linde, joining us next. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong this Wednesday morning. A bit cloudy out there. Futures are looking like this here right now, though, punching pretty high, up 0.4%. This is the China Show. All right, it's big on the agenda when it comes to Greater China today. We are, of course, waiting that big data dump at the top of the hour. So second quarter growth numbers there. We have June activity data, so certainly watching very closely. First and foremost, those home price data will come in around 15 minutes from now. There is that PBOC briefing coming up here as well. We're still waiting for credit data. Earnings, quite a bit to tell you about here. Longi certainly was one that we're tracking here today. And there is a CGB sale today as well. 30-year sale of CGBs. And on the earnings stories, a Longi Green. So we're watching that specific stock. They have guided towards a deeper first half loss. So we're looking at the entire cohort of solar and new energy. Gangfeng Lithium, Tianjin Lithium also guiding, but in fact, this one to the upside. So we'll watch effectively a lot of these things. And of course, within the healthcare space, more of these outsourcing, out-licensing deals to be more specific. So we'll see what the reaction could likely be as we go into the open here today, about 15 minutes away. Let's bring in Herald van der Linde, head of Asia Pacific Equity Strategy at HSBC. It's great to have you. I'm sure it's been an interesting first half for you.
Absolutely.
I mean, there's a lot of questions whether all the easy money from this whole AI boom has been made right now, given the volatility that we're seeing in parts of Korea, parts of Taiwan as well. What is positioning looking like for you now?
So we are neutral on Korea, but this could be a little bit of sort of what sometimes called a Minsky moment. A Minsky moment is you can have a rally in markets, But irrespective of why the market rallies, that in itself sets the seeds for some sort of adjustment. Because if the market goes up, people they're going to borrow and they're going to put more money out because they want to be in the market rallies further, and then they borrow more, and eventually then they stop borrowing or the interest rates go up and it becomes more costly, and you can see a reassessment. We've seen this in the past, and I think this is maybe what happens in Korea as well. Margin lending is high. We know, of course, of the single stock leveraged ETFs. So people borrow to put money into a leveraged product. Well, that's great if it goes up, but then, of course, it's a little bit less so if it goes down. Yeah.
Was there a bubble there?
The thing that's different this time is that you've got this earnings growth. So the bubble is actually in the earnings, and the earnings that's good. Very often bubbles are associated with markets moving away from fundamentals, and that is arguably not the case in Korea. Right?
It might be the opposite.
Exactly. So the earnings growth is phenomenal. I mean, at the beginning of this year, Korean consensus analysts thought there would be about 50 to 60% growth. We're now 250. So there's massive upgrades. On the other hand, if you define, say, bubble as speculation, people not looking at the fundamentals anymore and putting too much money into it, there are these elements there. So maybe what we now see, this sort of a washout, is a bit healthy for the Korean markets. Yeah.
But what does it mean? I mean, the fact that SK Hynix has an ADR listing now in the U.S., it seems like it's a 24-hour feedback loop, right?
Yeah.
Where you're feeding against each other, and then now it just becomes this sort of vicious cycle.
Yeah.
What could break that, do you think, this volatility? A regulator's going to have to step in.
Yeah, the volatility is just crazy.
Yeah.
I mean, I have, in my 35 years of career, I've not seen volatility in one market for such a long period in time this high. The Korean market is about 5 to 6 times as more volatile than, say, China or Taiwan and some of the other markets. So that's just really high.
Yeah.
What's going to break that? If, of course, we find out that the earnings are even better or worse or something changes on that front. But also, what we've seen with this adjustment is that maybe, the government says, hey, we've got to be careful with these leveraged products. Now, they just allowed people to invest in them since late May. But there's talk about them saying, well, maybe the minimum amount of money you can put into it is going to be raised to limit the inflows over there, just to make sure that people don't make the wrong decisions at the wrong time. Yeah.
So do you prefer Taiwan then as a cleaner, quote-unquote, cleaner play? Within the HSBC universe? And what are the opportunities beyond TSMC, for example?
Yeah, so broadly speaking, I think for most people is that the preferred market in this whole play very often is Taiwan on the longer run, just because TSMC sort of a more stronger position in that front. The first money went into Taiwan, then they later went on to Korea. It's just rallied much more. But Taiwan, you also see leverage building up. Also, these sort of things are building up there. But just not to the magnitude as what we see in Korea. Both markets we have an equal sort of yuan, actually. But I think the advantage that Korea has, if anything changes in that market on the AI front, is that it has all sorts of other interesting stories. Some of them are related to AI, so consumption's going up and the banks will be exposed. But you also have these nuclear reactors, you have defense spending in the world, shipbuilding. The Koreans are pretty good in a lot of stuff. In Taiwan, it's basically just one story, and that's AI, TSMC, and a bunch of other companies, right?
What does the rest of the year look like to you? Is there reason you think, just given the volatility in these markets, to maybe just divert a little bit of your exposure to other parts of unloved markets?
Yeah, I think that is gradually going to be the story for 2026.
Okay.
One, the volatility is so high that some funds will say, listen, I can't just have 30% of my portfolio in a couple of stocks that move 10% today. I'm overestimating a little bit. But that is so much that they say that is too much volatility in the product that I'm selling to people who want stable investments. So that is reducing some of that exposure, people moving towards benchmark already. And then they have to look at other parts in the region. And India starts to look a little bit better, so that's a place they could go. We've seen some inflows there. China, of course, is a larger market as well. There are some pockets where they could go as well. But I think that is going to be a gradual story. Also, we have, you guys just spoke about IPOs of Chinese chip makers coming up. Yeah. So there will be a supply response. That will take time, though. But maybe somewhere in 2027, the talk about the demand-supply situation in DRAM is going to shift. And the market's going to anticipate that as well. So that's something that maybe by late this year, early next year is going to be sort of a talking point as well.
I mean, would you be advocating that big IPO that's coming up in China, the big memory?
The big memory
player, since we mentioned it? Just given, I think, where we are in the cycle. That, you have all of these other, its peers in the industry have raised their looking to put its supply into this memory market, and how the industry dynamics look.
I would say in general, because I don't know this company in detail or anything, but I would say in general that in many industries, and this is from chip making to shipbuilding to car industries, initially the Chinese were the kind of low-end, cheaper product producer, but over the last 20 years, they've shown in so many industries that they can really move up and become competitive forces. EVs are, of course, a classic example, but we see this in biotech and healthcare products as well. So I wouldn't dismiss this whatsoever out of that sort of bigger picture.
Okay, we'll have more with Herald in a moment. There, Herald van der Linde, head of Asia-Pacific Equity Strategy at HSBC. Going into the open today, just under 8 minutes away, we're higher by about 1% on the Hang Seng index, and also on the currency itself. Given the drop in the dollar, the PBOC actually boosting the fixing by the most in a couple of weeks, most since April, given the dollar drop we've seen. Lots more ahead. This is the China Show. Welcome back, and good morning. If you're just joining us from across the Asia Pacific, we're going into the open today, just under about a minute away. As you can see, we are called higher across both onshore and offshore markets. The stronger fix coming through, perhaps also helping boost sentiment. In a couple of seconds, we'll be getting the first of many data points. Home price numbers are coming out in about the open, so we'll break that to you once they do drop across our terminals.
Yeah, it's interesting. There was a report coming up from Morgan Stanley saying that they had a survey showing the housing sentiment is actually recovering. But when it comes to weak purchase demand, that remains a drag on home prices here. So certainly there's a bit of, I guess you say sentiment is helping, maybe particularly in the tier 1 cities as well, but certainly it's not enough to lift tier 2, 2, 3 at this point in terms of the data is concerned. But let's take a look at how that open is before this home price data comes through. We're flat when it comes to onshore equities here, with the exception of Shenzhen. So that continues here. So risk really is on the table when you talk about what's going on in Shenzhen. We're up 0.5% on the Chinex. The news of CXMT, right, as they prepare for this upcoming IPO, certainly is lifting a lot of the domestic names here this morning. So Capricorn Tech is up just slightly. CATL A shares are still doing quite well as well. Shanghai crude, though, remains elevated, right? So despite that U-turn from President Trump when it came to these 20% levies in the Strait of Hormuz, we did see a little bit of a drop in oil prices, but then we quickly went up. The threat of possibly more strikes from the U.S. From President Trump in that Fox News interview certainly did, I guess, lead to still that bit of geopolitical uncertainty. So there you go. Flip the boards and see what else we're tracking here this morning. There is a CGP sale today as well, but Hong Kong's doing a little bit better than onshore here this morning. You're seeing the Hang Seng. We're at 24,500 levels. HS Tech is catching a bid here, really driven by the likes of Baidu, Tencent, really marginally, though, but you're seeing Baba, Meituan, and Xiaomi seeing 1% losses. So it's a bit of a mixed picture across the mega cap tech in China here today. Offshore renminbi at 676. We talked about this lifting of the fix here just to reflect on the dollar moves that we've seen overnight. Yes, but news of DeepSeek also, according to our sources, preparing for an IPO certainly could be quite interesting for this market as well. We're looking at chip stocks, right? We talked about Capricorn Tech here. The CXMT news could be quite interesting, as now we're getting a little bit more details about valuations, possible timing of this IPO, and that's really lifting the entire sector here today. You see ASMPT up close to 5% here right now, and some of these CXMT linked stocks as well. So I guess we're checking the whole supply chain here this morning, mostly lower, but we're watching very much those home price data. Is it out yet?
Yes, the numbers are out. Let's start things off with new home prices. We're down 0.15% month on month, so yet that streak does continue. You are getting some strength in the currency. This is perhaps more to do with the fixing. Just a stat on that negative 0.15%. That is the slowest pace of declines in more than a year. So the direction of travel remains constructive. We're not back at zero just yet, so we'll just have to wait a couple of more months if, in fact, that is the eventual outcome here. Used home prices are down by double. The new home prices were down by 0.32%. That's month and month, which is an acceleration from May figures. So new home prices are doing better than the secondary market.
Yeah, it's interesting too, right? We were just talking about positioning with Herald Vanderlyn from HSBC. The Bank of America Fund Manager Survey came out overnight, and they talked about, for those, long stocks and being really aggressive about it, maybe it's time to really kind of tame your exposure a little bit here. They said, it's uber low when it comes to cash levels right now. And really, it seems like things are just quite extremely bullish when it comes to where asset allocators are, which to them is a typical warning sign for markets here right now. So summer upside for risk assets, they say, still remains stymied by the bull positioning that we're seeing. Yeah, but it's interesting too, right? The most crowded trade, no surprise, semiconductor stocks.
I think 80%.
Yeah.
Something to that amount have put out that sentiment. Now, what's the Asia angle to this? I think the least loved market when you look at the Asia component side of the survey is actually China as a market, right? So when you look at 20% are net underweight Chinese stock, it's the least favored markets, including, by the way, I should mention, India and Indonesia. And again, unsurprising to the AI point you just made that Taiwan, Japan, and South Korea remain the most favored markets there. We've talked a lot about the most favored markets. Why don't we focus on the opportunities in some of the unloved spaces here, China, Indonesia, and India. Still with us here on set, Herald Vanderlyn, head of Asia Pacific Equity Strategy at HSBC. What are you seeing in positioning as far as mainland Chinese stocks are concerned?
Well, what we've seen is, of course, all the attention has gone to Korea. And we haven't really seen building positions in China, so not too much of inflows, but because the market has come off a little bit as well, people actually got a little bit more in their portfolios, you could say, to that extent. So there's not a strong appetite to go into China at the moment, but I think there's a couple of pockets where people talked about. I was in Europe over the last couple of weeks, and people want to talk about what happens with the banks there. They want to talk about with the property cycle, because the parts of property that do much better than the numbers that you were just talking about, the overall market, that's where some of the companies, of course, are positioned, right, and busy. So property came up, banks came up, but also, of course, hardware came up, biotech and healthcare is a sort of a new area that people focus on as well. So, there is interesting pockets in there, but not overall very strong.
Would the earnings season change your view on anything?
Well, the earnings expectations are pretty okay. If you just look at the overall numbers, I think it's 12% for China earnings growth. What is more interesting, I think, if the earnings are starting to come through, two things. One are the banks, because we don't have that flow coming from China into Hong Kong anymore. That seems to slow down. So that's got to stay in China. So that must be good for banks. There's I think, $10 trillion of deposits that will expire this year in China. So people put money in a time deposit, got 2.5%, 3%. Now they get 1.7 or something like that. So the margins of these Chinese banks can go up. The other interesting story will be what is going to be the pressure on margins for the internet names. Because the competition has been the overall story, and that seems to weaken, right? It's not as bad as it was 12 months ago. So that's something.
The price wars might be behind us.
The price wars are coming down a little bit. So that's something really interesting to look for in China as well. So
the year in Asia has been extreme. So we talked about Korea as top. The very bottom of the barrel globally is Indonesia. You're an expert on Indonesia. What do you make so far of? Have they said enough to convince you and market participants?
I don't think, clearly they haven't said enough yet to convince, because the MSCI said we are going to wait until November and then we're going to make a judgment. It does seem to me that Indonesia is trying to do everything it can in order to meet these requirements. That means that free float needs to go up for some of these stocks. So that it seems like they're moving in the right direction. It will create a bit of an overhang. So there are certain stocks whereby, let's say, only 5% of the stocks is traded in the market. The rest, 95%, is held by a family or a small group of people. And now the MSCI says, that's not enough. You need to bring that to 15, 20, or the Indonesians say you need to bring that to 15. So that means that 10% of the market cap of that company now needs to be bought by somebody else. So these things now need to work its way through the system. We need to see an increase in that free float. They've taken some of the stocks out of their index as well. So I think Indonesia is moving in the right direction. I don't think Indonesia will leave. It doesn't have to leave. Some of the largest ASEAN banks are in Indonesia.
Right.
So
it's a massive economy.
Exactly. So having that one not in the ASEAN universe looks odd to me. But things need to be. The Indonesians can't just sit back and say, "Well, we're big enough. They're not going to do this." No, they need to do more. But it looks to me, from what I see, announcements, changes in personnel they've also put in place, looks like they're really working onto this.
Harold, always great to talk to you.
Thank you.
Thank you so much. Have a great rest of your summer ahead. Harold van der Linden, Head of Asia Pacific Equity Strategy at HSBC. So Yvonne just mentioned earnings here. We are going into the thick of things in the Chinese markets. A couple of guidance coming through here. A couple companies coming out with some fairly decent guidance in as far as, well, I think for Tianqi Lithium, and I think the percentage numbers do underscore the fact that we are somewhat coming off a favorable base. Markets are reacting the opposite way. 3% down. Ganfeng is also out. Those are the A shares you're looking at here. And, of course, the other big story here is on Longi Green, which guided towards, I think it's a deeper loss here out of the company.
Yeah, a bit of a warning sign there. Let's talk a little bit more about that. The Chinese solar giant Longi Green Energy expecting its net loss to widen in the first half despite a surge in exports earlier in the year. For more, let's bring in our China renewables reporter, Dan Murtaugh, with the latest. Dan, just walk us through what we've learned from Longi here and why they are projecting further deeper losses.
Yeah, I mean, the big thing here is looking at global solar panel demand. For the solar industry for the last couple of years has been mired in this overcapacity. People built out too fast, and so they've been, selling, cutting prices, selling at very thin profit margins. But they had been sort of like, kept going because demand for solar panels kept rising. This year, we're starting to see that fall back. China is the biggest solar market in the world. It's about half of the market. There's a huge drop in installations this year after new power pricing rules came in play last year that forces solar panels to be, or solar power to be priced much more competitively. And so this underlying demand from within China is basically disappearing, and that's adding an extra bit of pressure to these guys who are already selling at super thin margins. Now they can't even grow their volume.
Well, I mean, do we look at this as a Longi story? Is it, in other words, when these other companies come out with their own guidance, how do we look at the overseas market, which I think you alluded to, could be the runway here, given the capacity issues some of them actually have, Dan?
Yeah, we've seen a little bit of an uptick in exports of solar panels earlier this year. That was partially due to some exogenous factors. China ended an export tax rebate, so people were front-loading some exports earlier this year. But you have seen since the end, or since the Strait of Hormuz crisis broke out, oil and gas prices going up. A couple of markets, notably the Philippines, have really sped up green adoption, and they're really increasing their solar panel imports. And so that's a bright spot for some of these companies. But it's not just a Longi story. This is across all solar manufacturers. We're seeing more companies that are coming out with their preliminary earnings. They're still looking at heavy losses in the hundreds of millions of dollars for the first half of this year, after losing money last year, after losing money before. So this is a long-term problem for the entire solar industry. And there's no real magic bullet. There's basically at least double, if not triple, the amount of capacity to produce these panels as there is demand for them. And until companies sort of run out of money, go out of business, consolidate by buying each other, and shut down some of this capacity, there's not going to be a real way for them to restore their margins and restore their profitability. And we've been waiting now for more than a year for that to happen. There's still no real signs of that.
Dan, thank you. Dan Murtaugh, our China oil, gas, and renewable reporter in Beijing for us. We're about 11 minutes into the cash market session. Asia markets under pressure. Hang Seng and some of the benchmarks here in Hong Kong and the rest of the region, we're actually doing quite well. That's a glance, and the Kospi is doing its Kospi thing. Still, lots more ahead. This is Bloomberg.
There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view. The members of our committee have no tolerance for persistently elevated inflation. And we share a resolute commitment to ensure price stability. Productivity growth has been strong, predating gains from AI adoption. America's labor force appears stable. Job creation has in fact kept pace with the workforce. We want economic growth to be more broad-based. This committee had long committed to a 2% inflation target. That is our resolution. That's what I'm here to say and double down on.
Kevin Warsh there, the Fed chairman, speaking to U.S. lawmakers in his testimony here today. And certainly I think the CPI print did kind of help him in some ways here to have a pretty easy, I guess you could say, hearing, so to speak, given that they were softer numbers across the board. You know, CPI basically declined in June for the first time in 6 years. So certainly that is a telling sign here. But certainly a lot of questions about, you know, what he said, right? I mean, he mentioned about the different types of options that they could have to try to tame inflation back to that 2% target. And really, I guess people were kind of going with it and saying, look, maybe he is hinting a bit more hawkishly.
This guy is taking inflation very serious.
Even though he doesn't like forward guidance.
No. Well, I think that's clearly been enough for markets, right?
Yeah.
We went from, I think, 44% probability of a hike in July to not completely down.
It's gone.
It's gone. In fact, just on that note, right, our next guest actually thinks that markets may have gotten ahead of itself here when it comes to pricing in for a Fed rate hike. Joining us from Singapore is UBP's Asia Head of FX Sales and Execution, Ignatius Pang. Ignatius, good morning. Well, okay, talk us through then. So with the softer inflation print, I think the statistic is it's the first negative month-on-month print going back to 2020. For now, can we rest easy that we don't see a stronger dollar near term?
Thank you, David. Well, I think in the numbers itself have actually proved a little bit. I mean, it has rested the dollar's ascent that we have seen over the last few weeks itself. But I do agree that we are still in the very early stage of actually discerning whether or not the Fed would need to hike interest rates. Given that those in the next, what we have seen overnight was also repricing for inflation of interest rate expectations from the Fed, from hiking in July to the market pushing that back into this September meeting as well, with a bit of a 50% probability there. Now, resonating to what Kevin Walsh had mentioned overnight, if the Fed not tolerating any persistent form of inflation, we do see actually the next few months of data having a larger bearing on the US dollar. In the sense that we probably have 2 non-farm payroll readings and also 2 more CPI readings in probably allowing us to have a better, clearer picture as to whether or not the Fed will need to hike interest rates in 2026. Having said that, I think Walsh is also, I mean, with the absence of or the dislike for any form of forward guidance coming from Walsh as well, we do expect that the data dependency of the dollar will be quite volatile in the very short term.
Okay. What about, you know, the Middle East risks, right? Some would argue that that does support the dollar. Do you think that's the same way now versus maybe earlier this year?
It would be as well, and what we have seen transpire over the last few weeks as well, with regards to the on and off peace deal talks that have been going on as well. This had also created the same amount of uncertainty towards the dollar's direction. True to form, any resurfacing of the crisis would be beneficial for the dollar in terms of the persistence of higher inflation rates in the US. This in turn is also expected to influence the dollar, and we have clearly seen that very much with the performance of the precious metals when it comes to any re-escalation or de-escalation in terms of the Straits of Hormuz.
Since you brought up precious metals, you know, some of the best performing, if not the best performing group of currencies that have returned, you know, given us the best returns year to date, have been linked to commodities, as you know, Ignatius. Do you think there, you know, that group has, that rally has legs, or do we turn elsewhere?
It wouldn't be the end of the story at the moment. I think what we have seen for gold correcting about 29% from its all-time high is more of a healthy correction, and this has very much been driven by the ETF flows that had surged in late last year as well. The structural story is still very supportive for gold, especially on the premise of central bank buyings. purchases of gold, which has not abated to date as well. Although he has slowed, but the presence of, I think, central bank purchases has also been a floor for gold at the moment. We would need to see certain conditions in order for the precious metals to actually start to reinvigorate their upside. And that would be very much from, number one, certainty towards the Straits of Hormuz, whether or not that opens up again. And number two, the easing of any inflation pressure. So to that degree, we do expect also that the next few months of data, especially from the employment side of the for the US and also on the CPI side, will be quite determinant in whether or not we have actually found a medium-term floor for the precious metal. But we are confident that we are probably seeing a little bit of a base effect on the precious metal right now, a base floor on the precious metals, with our structural view that we do see the precious gold, for example, heading up to 4,800 by the end of the year.
Oh, okay. That's interesting. I have to ask you about another good performer, really, and it's been the renminbi, right? Arguably one of the best currencies in Asia so far this year. Can it stay in that sort of ranking for the rest of the year, you think?
I think the renminbi will be very much dependent also on the Straits of Hormuz and what transpires there as well. Where we were at the start of the year, I think the RMB was one of the best performing. To date, it's still one of the best performing Asian currencies, having gained about 3.6% to date. And this is definitely ahead of all the Asian currencies that, in terms of the year-to-date performance. In terms of whether or not the RMB will continue to maintain its gains, I would say that we are probably in a very lackluster range for the RMB in terms of price action for the next few months. Again, it is very dependent on the Straits of Hormuz and what transpires there, given China's heavy reliance on oil. And also, if once we have the Straits of Hormuz open up again, and a little bit more stability on the front, we do see market reverting to fundamentals in terms of the RMB's valuation. And currently, on a real effective exchange rate perspective, the RMB is about 9% undervalued against the US dollar. But having said that, in a very low interest rate environment, we would actually need to see the RMB strengthen much more on a nominal term in order for it to catch up to its real effective exchange rate. But for the moment, I think we're going to see a very lackluster range in the RMB between 6.7 to 6.8.
Ignatius, we got to leave it there. Thank you. Ignatius Pang there, Asia head of FX sales and execution at UBP. We'll have much more on markets later on. We're going to hear from PIMCO's core strategy CIO, Mohit Mittal, on why he expects U.S. Fed chairman to reinforce a data-dependent approach. That conversation at the Times on your screen. This is Bloomberg.
Okay, we're just counting down to the release of quite a ton of data, right? So I think we're sandwiched between, we're still waiting on the credit numbers, I believe, and we're still within that window. We're coming off this time yesterday some trade data, which was actually very, very good across most metrics, I would say, relative to estimates. Decent home price numbers, and as far as the direction of travel, we mentioned the fact that new home prices are falling by the slowest pace going back over a year or so, negative 0.15%. And of course, we'll get new home price, we'll get the activity numbers and, of course, the backward-looking GDP numbers coming through in about 6 minutes from now.
Yeah, but, we'll start to see, right? If it gets closer to the bottom of the end of that target, right, of 4.5%, right?
For the year, yeah.
For the year. So certainly the second quarter, the momentum seemed to have stalled a bit here, and really that's been driven by the retail sales side of things, the fixed asset investment. We'll see how the June really stacks up here, but we're looking for some pretty soft numbers on those certain segments. Industrial production might still see that strong side. Property investment still double-digit losses as well. So certainly we'll see where this K-shaped economy goes. We'll be breaking down that data as it drops, right? Zhang, President and Chief Economist at Pinpoint Asset Management, is going to be joining us to talk about that as well. So yes, a lot on tap.
Lots to get into, so we'll break the numbers down in a couple of minutes for you. Get instant reaction from, of course, our guests coming to us, Yvonne is pointing out. Plus, of course, a recap of these markets where bulls are out and about this Wednesday morning. Lots more ahead. The second hour of the China show is just ahead. Good morning. Welcome back. The second hour of the China show is soon coming. The reason I say that is Korea is forcing my hand again. Just a quick update. We're up 6.5% in Korea. Some comments coming through out of the president here talking about how things are not stable in the markets. And I think suffice to say, on any given day, you could see a move to this extent, 6.5%, but we are seeing a rally today. Now, back to the China story.
Yeah, no, when you take a look at what SK Hynix stock, basically what's done on Monday, right? I think Goldman Sachs said basically because of these leveraged ETFs, a lot of these funds had to basically sell. I think they were talking about $5 billion worth of the stock just to meet, reduce their exposures just to meet their mandates, right? I mean, that just goes to show that this is really a market that's really been driven more by leverage than the fundamentals itself. The data is out from China, and here we go. Let's start with the second quarter GDP numbers here. So we're talking about 4.3% for the second quarter. That is a miss on estimates there, and it is short of that target, really, of the year-end target, I should say, of 4.5% to 5%. Retail sales, though, this one seems to be a bit of a surprise to the upside. We're talking about 1% gains for retail sales. The street was expecting a median estimate of negative 0.1%. So that's a massive beat there. What else are you seeing, Dave?
Yeah, so just the 4.3% in context. So it's clearly below the median of 4.5%. Across the range of forecasts from the street, it actually came in below almost every single forecast, with the exception of, I'm counting 3 economists here. So clearly on the low end of expectations here. This is, of course, for the quarter. Backward looking, of course, statisticians will need is, of course, to calculate what the base looks like and what the base should be going into the second half of the year. But to Yvonne's point on the monthly data, perhaps more on the encouraging side, right? So IP, 5.3% better than estimates. That's factory output. Retail sales, Yvonne talked about that. We are getting a flip back into positive territory. And I put this against the backdrop of the home price numbers 30 minutes back, which actually showed a lesser decline on new home prices on aggregate. So just looking at that, what else? Jobless rate coming in at 5%.
Also a tick lower.
Also a tick lower there. What else are you tracking?
Property investment continues to be a negative story, right? We're talking about losses of 18%. So that is also worse than what was expected. Year to date, I should say, from what the median estimates are. So that certainly is what we're seeing. It's a mixed bag, but for the most part, there have been some surprises to the upside here as well. Let's bring in Zhang, President and Chief Economist at Pinpoint Asset Management. So I think April and May was quite soft. Yeah. What's your take on the June numbers?
I would say look at the whole set of data.
Yeah.
It's not perfect, but it's okay, I would say. If I were in Beijing as a policymaker looking at this set of data, I would say there's, some slowdown in the economy, but they are still on track to deliver the growth target for this year. Because the first quarter, they achieved 5%. Second quarter, 4.3%. Combined together, they are still kind of in the midpoint of the range that they want to achieve. So I think the pressure is not that high for them to change their policy in a very significant way. We'll see. I mean, the last week of July, we will get a Politburo meeting, and they will set the policy tone. But I think, and the point that you made, that the first 2 months in Q2 is weak, but now we get a little bit of rebound, right? Particularly retail sales turning positive. So I'm not sure, they have to do something very meaningful.
What would drive that retail sales to go positive now? What do you think was behind that?
Yeah, I'm a bit surprised, to be honest. I would expect, a slightly negative number as well. So I have to look into the data points. Yeah. Sometimes this monthly data is a bit noisy. The high-frequency data point we track, not that strong. So, yeah, I'm curious as well. Yeah.
How would you describe domestic demand compared to, let's call it, because month-to-month it can be noisy.
Right.
Compared to this time last year, how much have things improved in domestic demand?
I don't think it changed that much. What changed on the margin is the policy, right? So last year there was a lot of support for subsidies and for autos and electronics and all these products. They are fading out, right? So and their marginal impact fade out as well because you can't buy too many cars. So look at the headline numbers; they are not as strong as last year. But if you look at the consumer sentiment, you look at household saving rate, these kind of things, I would say roughly the same as last year.
There's a fixed assets investment picture, which has been turned negative the last few times, last few prints here. And it seems like that's deteriorating, right, when we're talking about a 5.7% print here. What does that tell us fiscally, right? It seems like they're not willing to really kind of spend when it comes to infrastructure investment. It's all about curbing debt risks in local governments. Is that likely going to stay?
Yeah, that's the point where I think in Q3 we might see a bit of a pickup. So what happened this year is first quarter, I think the government was really pushing to deliver a pretty good GDP growth number, and they did it.
Yeah.
And then the second quarter probably they felt, okay, we don't have to overshoot again.
Yeah.
So if you look at the fiscal numbers, like fiscal spending, debt issuance, they were kind of behind schedule. Now going into Q3, I think the pressure is on. I think the fiscal side we might see a bit of a pickup. That could help to bring the overall GDP numbers stabilize or even improve a little bit in Q3.
Yeah, in fact, we ran a story today on the Bloomberg, and this is based on projections from several brokers here, to your point. I'll read a headline, I think the graphic's coming up too, that China is set for a record bond issuance this quarter. And I think also on the back of the story, the PBOC might be looking to inject some liquidity. So you get, of course, some of the take-up here. There we go. 4.3 trillion is the estimates for the third quarter specifically. Talk to us about how you would describe the attitudes among fiscal authorities here, and as far as where do you think the spending might pick up, and where do you think they need to? They've been very careful about the debt buildup too, as well.
Yeah, I think the first half of the year, I think on the fiscal front is very quiet. I think the revenue side is doing okay, but the spending side is not particularly strong. It feels like there's no urgency to push out this fiscal spending or infrastructure investment. But I think now with this Q2 GDP number, we probably will see more incentive for the fiscal authorities to speed up their operation. And that happened in the past few years. It's kind of a seasonal pattern. First quarter is good, and then by the middle of the year, the economic weakened a bit, and then second half of the economy, the government try to push on, particularly on the fiscal side, and improve the economy. So I would expect the pattern to happen again.
What should I expect for exports? Is that
export is super strong. I think so. It's really amazing in the past few years. Continue to beat our expectation and market expectation, right? And the June number is super strong. Single month, more than $400 billion US, record high. I think the second half, it will continue to be very strong. Look at the momentum. It's very broad-based. The AI boom is happening. Auto sales, all kinds of... if you look at the products and the country breakdown, it's pretty broad-based. So I think Q3 export continue to perform very well. That's the major driver of the economy.
I mean, is it just me, or it's not as exciting on the macro front? In China, lots of people talk about exports. Within exports, a lot of people talk about tech. I mean, you spend a lot of time in Shenzhen. Are we ignoring some of the stories that we should be focused on here, like tech, for example? Like what are people talking about?
I think from the investors' perspective,
what's exciting?
I think even in the beginning of the year, there's already a very strong consensus that domestic demand is weak and probably will stay weak for a while. And the government response there is not overwhelmingly strong. So
it's stable, though. That's a good thing.
Exactly. It's stable. It's not falling very quickly. If it falls very quickly, the government will respond very quickly, right? So you get more volatility, and it will make investors of the market excited. But it's kind of stable, so it's a bit boring. Whereas on the other side, on the AI story, on the export story, you do see bottom-up firms delivering very good numbers. And we've seen, global investors coming to China. That's where they want to go. They want to go to the factories, look at the AI companies, robotics, all these companies. And you can tell a very exciting story, and they buy it. So there's sort of a bright spot, that structural story that people focus on.
But is it too concentrated, though, on just, electronic manufacturing? Can it actually spill over to the broader economy?
That's a big question. I think on the very senior level, on the government level, they're hoping that these bright spots will broaden out. And in China, you could argue this is because what China is good at is applications, right? So they're hoping that AI can be applied to a broad range of manufacturing and service sectors. that we hopefully in the second half we'll see more examples.
Zhang, thank you so much for spending the time here with us, President and Chief Economist there at Pinpoint Asset Management. We were just talking about, of course, the context here, and we are getting more context coming through out of the National Bureau of Statistics, currently holding their briefing on these numbers. We will leave you with a look at some live pictures coming through there. In case you missed the numbers coming through, 4.3% on 2Q growth, estimates for slightly higher than that. The retail sales number, of course, was the positive takeaway so far, coming in positively. 1%. We were expecting somewhat flat number there. Lots more ahead. This is The China Show. Okay, how are we doing? Actually, that depends where you look. It's generally boring session, if I'm being honest, completely.
At least there's a lot of green.
Well, I mean, look at Korea.
Yeah.
So one of the first things I did when I woke up was clearly I looked at who won, or the ongoing match between Spain versus France.
And then you watched the, what?
And then I looked
Kevin War's testimony?
Well, the ADRs, and then the testimony came after that. And, of course, the big move in SK Hynix going into today. But, yes, I mean, I was caught between three screens there.
So many priorities.
Yes.
Yeah, so certainly it's been quite interesting, really, this whole South Korea story. You heard from the president just speaking in the last couple of minutes.
Yeah.
About, you know, it's quite unstable, might take some time to stabilize, so hang in there in certain ways. But we talked about really just the power of leverage and really how that is really driving a lot more of the flows than really the fundamentals itself, because that still remains to be quite strong. I think SK Hynix reports in I think another week or so.
Yeah, and I think the point, I want to bring up HSBC, right? They joined us this time in the last hour.
Neutral in Korea.
They're neutral in Korea, not because of the fundamentals,
yes,
but because it's just too crazy, right?
Yeah.
The leverage is just keeping some of the fundamental stories, overshadowing the fundamental stories there. We're looking at Chinese markets. We're flat right down to CSI 300. We're slightly higher still on the Hang Seng Index. HS Tech is splitting the difference between the two. 4.3% was the growth numbers for 2Q, which came out about 14 minutes back.
All right, for more, let's bring in our managing editor for Asia Equities, Linde, too. She's with us here right now. Korean stocks seeing a big rebound today, but we were just talking to Herald Vennerlin from HSBC. He says, I've never seen volatility like this in Korea, ever, since he started covering Asian equities and Korea itself. And with this ADR listing now of SK Hynix, you're starting to see it's almost like the volatility is feeding each other in Seoul and in New York. Do you think Korea is in some ways exporting some of that volatility globally now?
Yeah, definitely. As you guys were talking about, you know, one thing that people are waking up to check first is how SK Hynix is trading overnight. So yes, before I would say SK Hynix was very much a Seoul story. Wall Street would react to it via proxies like Nvidia or Micron. Now SK Hynix is listed in both markets, and sentiment can travel much faster. So if the ADRs fall overnight on Wall Street, then that sets a tone for Seoul trading. And in Korea, as you guys are talking about, with all the leveraged ETFs and margin trading amplifying moves, then that feeds back to the US, creating this kind of 24-hour feedback loop, which can be very unhealthy. Now, fundamentals definitely still matter for these chip names, including AI demand and earnings sustainability. But in Korea, what it tells us, our investors right now, is market structure can have outsized impact in a very short period of time. And in Korea, there is concentration in two big chip names, taking about half of the Kospi, and also with leverage layered on top of these globally important AI names. That's why you're increasingly seeing that moves in Korea is spilling over to the rest of the market before investors even have had time to digest the fundamentals.
Okay, well, let's talk about memory here, because that's effectively the Samsung and SK Hynix story. But we're now getting a fourth player, the CXMT. We know a lot more about this big listing that's coming. How does that then affect, well, I think for one, market structure and mechanics, now that we have that big name in mainland China coming soon? And what does it mean for this race between, for AI between the US and China, Lianting?
Yeah, it's definitely a very sizable deal. We're talking about $10 billion or so for the fundraising. There's definitely a sense that the AI race between the U.S. and China is heating up, not just in the product development area, but also in the fundraising space. U.S. had SpaceX, and we are expecting Anthropic and OpenAI to come in the next few months. But in China, we are also seeing gigantic listings in the pipeline. CXMT as one example. Yangtze Memory is another one that's waiting in the wings. And we also had a scoop last night about DeepSeek looking for a listing potentially next year. One thing to note is that the overall fundraising size by Chinese companies is still much smaller than the U.S. peers. Part of it is because Chinese companies are just a bit more cautious in fundraising. And second is the U.S. market has a lot more liquidity than China. So let's say in the debt market, China TMT names this year to date raised about $40 billion onshore and offshore. That compares to about $80 billion raised by Alphabet, Oracle, and Microsoft in the debt market this year. But with Xi Jinping set to appear in the AI conference in China for the first time ever, it sends a very strong signal to investors that he's throwing his personal weight behind the AI development, the race between U.S. and China. And the signal is that potentially these Chinese IPOs will do well, at least in the short term. And also, liquidity may not be a problem.
Lanting, thank you. Lanting to our managing editor for Asian equities in Singapore for us. Just an update here on Iran, the U.S., I think almost as a daily feature now, an update here, that the U.S. has completed more strikes against Iran. The military has completed those strikes, and that's just a headline that's come through just now. Lots more ahead. This is Bloomberg.
Looking forward, we know that things rarely move in a straight line. While we continue to see a largely resilient economic backdrop in the U.S., risks can emerge quickly and drive periods of disruption and volatility across markets. A keen focus on risk management remains paramount as we support clients across a range of market conditions. But it's also clear that we are seeing broad-based momentum across the franchise and a very strong environment for client activity.
I can't tell you that it's impossible that we will exceed the 11%. We're just not going to box ourselves into that, given that we see opportunity to take actions on the offense, which are accretive to shareholders and support our path to our medium-term targets.
I just think we're in a very healthy, active, exuberant market with very high prices and very high volumes, and we benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better, but how much better, I don't know.
All right, that was the chiefs. So some of the biggest U.S. banks on those record second quarter results, some of their stock trading divisions, and really the equities business was just booming, right? Just take a look at what happened with J.P. Morgan, reported its highest ever quarterly profit with its equities haul climbing 86% from a year earlier to $6 billion. So that beat even the highest estimate. Bank of America, meantime, posted nearly $3.3 billion in profit for that period. And the company says consumers are keeping up with their bills and continuing to spend on discretionary items. Wells Fargo also beat the street on higher fees from wealth management and investment banking. Net income for the last 3 months jumping 17% to $6.4 billion.
Yeah, Goldman Sachs raising at this $10 billion from a high-grade bond sale after reporting, of course, also record stock trading results. The firm's equities unit then selling all-time record here as far as for any bank, raking in $7.4 billion. Meanwhile, Citi shares, have a look at that and where we are there. There we go on your screens there. Slumping, despite, of course, stock trading revenue on the same line surging also quite substantially, 45% in Citi's case, and executives say they plan to bring forward job cuts and key tech investment?
Yeah, certainly there seems to be some good sort of momentum that's going on. And for more, let's bring in our Bloomberg Intelligence U.S. Banking and Financial Senior Analyst, Herman Chan. Herman, you heard from some of the banks just now, some of the CEOs about just how strong the quarter was. I think Jamie Dimon had an interesting take, right? He mentioned this could be as good as it gets. How sustainable do you think the strong trading results are going to be for the back half of the year now?
That's right. No doubt about it. The second quarter results, particularly in equity trading, were fantastic. Hard to imagine we'll see that sustained over the longer term, but at least in the back half of the year, we expect still robust trading results, maybe not the same extent of the second quarter, because the second quarter did have some exogenous events. We had the big SpaceX IPO in the U.S. There was strong trading activity related to AI names. But the overall theme of higher equity volumes, structural changes in the likes of ETFs, leverage trading, algorithmic trading, that's all feeding into the equity trading line that's fueling the profitability for the banks.
Herman, talk to us about, Citi was peculiar, relative underperformance, of course, but you did have a very strong earnings beat there. So square that circle for us.
Yeah, that's right. Coming into the quarter, we had expected Citi to really build upon its first quarter performance. That was 13% return on tangible common equity. They did that again in the second quarter, boosted by higher trading volume, boosted by investment banking activity, and really strong fee income in its services business, which is the crown jewel of the franchise, with cross-border payments activity. That being said, Jane's comments that was just earlier on the show alluded to the fact that the company is investing in technology, broad-based investments, potentially higher severance costs in the back half of the year, and reiterated their full-year guidance for returns of 10 to 11%. Versus the 13% performance in the first half of this year. That sort of signals that profitability could decline in the second half of the year, driven by higher costs.
Okay, well, if rates go up, and this is obviously the Fed conversation, but that bleeds into things like net interest margins, for example, net interest income, how does that affect, how does the macro affect the micro here?
Yeah, that's something that the banks did touch on in their guidance. So both JP Morgan and Bank of America lifted their net interest income guidance for the year. Both of those companies talked about a larger balance sheets driven by higher deposits, higher lending, but also a higher for longer interest rate backdrop here in the United States. So the expectation that we could get a potential rate hike in the back half of the year, that's helping lift net interest income expectations and can solidify margins for at least the largest banks, as long as we get this continued deposit inflow at relatively manageable pricing, which is something that the banking industry and the analyst community were looking at, potentially higher deposit costs and lower margins going forward. So that's one. If we would quibble on expectations of the second half of the year, the biggest thing we're looking for is the margin compression from higher deposit costs.
Herman, thank you. Herman Chan, Bloomberg Intelligence, U.S. Banking and Financial Senior Analyst there. A very, very brief look at some of the movers. This is really an earnings and profit story across these two names coming up on your screen. National Building and, of course, some of the A&H shares of China Life. More of these actually coming up soon. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets are going on a lunch break in just a moment. And yeah, Tokyo is looking pretty sunny here right now. And yeah, pretty sunny when it comes to, if you're long these equity markets, right? We're up 0.8%. The Topix is also above that 4,000 threshold. Those US CPI numbers softer on the back foot. And so really on the back of just what we heard from Kevin Warsh. So I think that helped really kind of lift up the mood here overall when it comes to this whole AI trade and the like. 162.11 though, still pretty weak when it comes to the Japanese currency. currency, although the dollar has softened since those inflation numbers came out from the U.S. as well. JGB yields are also heading lower. We're down some 3 basis points for your 10-year. Checking IBM, because it was that massive move that we saw, right?
God,
the shares basically tanking. I think it was the biggest drop since 1968, I believe. Just with that profit warning from the company here. So we're watching some of these suppliers, some of these software stocks. You're seeing that being felt in the Asia session here today. The likes of NEC is down some 5%. In Japan, King D International also down some 3% as well.
Yeah, quite a statistic, that one, huh? 68. Okay, just very quickly on the earnings story. So we talked about China Life, really some of the busiest trading we've seen in this stock relative to what we're usually used to seeing on the average here for both. That's an earnings story. Innovent Bio, we've talked a lot about this theme of out-licensing deals. I'm not going to get into the name of this specific product. You can read about it bottom of your screens. But effectively, the market is running with this. We're up 7% in as far as this specific stock is concerned. There's also some other things to talk about within the biotech space, which really, by the way, has been extremely hot in China, both in public and also in private markets.
Yeah, right. When we were talking to Herald Vanderland about, when it comes to EVs, when it comes to biotech, you start to see, right, where China has become almost like an emerging leader in these industries as well. So even when it comes to chips, he says in CXMT, don't really underestimate really what these companies can do. So certainly that's one thing to watch. Let's talk a bit more about the PE side of things, right? So French private equity firm Ardian has been boosting its presence in Asia, opening an office in Hong Kong last year. And the company says it expects its Greater China assets to rise to more than $15 billion in the next 1 to 2 years.
Yeah, let's get more on their plans, what they're doing, what they're busy with, what they're seeing as far as global trends are concerned. Joining us exclusively here on set is the Executive President, Philipp Schmitz. Very nice to see you, and thank you for coming in. I know you're very busy during these regional tours.
Yeah, thank you for having me. It's great to be here. Very nice.
Yeah, so what's keeping you busy?
So what's keeping us busy? A lot of things. I mean, the demand is still there very much for all sorts of alternative investments. Right. We're very focused on secondaries. We're a market leader in that space, have raised a big fund, but also the other activities, direct private equity, private credit, infrastructure, all of that.
Why has secondaries picked up quite substantially, I would say?
Yeah, it has indeed. And I mean, I'll give you a couple of statistics, data points. We raised a 30 billion platform last year. We closed that fund. That makes it one of the largest closed-end pools of capital globally. And the market itself doubled in size from 2023 to 2025. It was roughly 110 billion. It doubled to 230. I think there is no other private market class that grows that much. The third element is, if you look at total exit volume of private equity buyouts in these past years, if you look at 25 alone, roughly 600 were exits, of which more than 200 was secondary. So it's just a big, important, integral part of all overall exit activity and liquidity for LPs.
What do you see in terms of the appetite from institutional investors on buying and selling these secondaries now?
Yeah. So it's become really it's not a niche anymore, so the sellers really like to tap into that market because the underlying assets are being more difficult to sell overall. In COVID, many people bought into the companies at higher valuations. Now it takes a bit of time to digest those. And therefore, we see also a lot of first-time sellers, also from Asia. We've done many, many transactions from sellers here out of Hong Kong, out of Greater China, out of other parts of Asia.
What do you think is driving that pickup in trend? I mean, is it because you're getting so much deal activity, you're seeing valuations almost double every couple of months on some deals? Is that what's driving just the preference for earlier exits, I guess, is a way to put that?
It is really liquidity, and especially in private equity, because private equity compared to infrastructure or credit, clients have been investing in that since decades, right. and many are at their target allocation. And then, they either cannot invest anymore for the next 2, 3, 4 years because they're at their target, or they say, well, we're selling some of these assets, therefore we get new liquidity in, and we can do new investments and get free co-investments. Or they say, we're overweight a certain region, we want to be more Europe, or we want to be more Asia, and they're reducing their US allocation.
I see.
These are the different reasons,
How has fundraising been in Greater China? I believe you've raised about close to $16 billion.
That's right.
What's been really driving that, you think?
So We've in fact last year had our best year even. Out of the 16 billion, roughly 4 billion was raised last year. So it's really huge. And we're seeing two things. One is definitely interest for the broader secondary platforms, but also an increased and renewed interest in Europe. Of course, there were investments in Europe before. As you know, our roots are European, while we're a global firm. Our roots are there. And we've seen greater China clients investing into infrastructure, into buyout, into private credit. They were amongst the largest investor base, in fact, for the infrastructure fund that we just closed last year. We closed a $20 billion platform, making it the largest European platform in infrastructure. So that and we're seeing that still now. That's great. Very happy about it.
I mean, you guys opened an office here, I guess,
Yeah.
if I have to say, in terms of just solidifying your footprint. What are your plans specifically there? Where do you want to take your presence here in Hong Kong?
So we're 15 people now here, and we're seeing directly that it's, there's huge growth. I mean, I want to add, though, that we've been in the market for more than 10 years already. We have clients here in Hong Kong for a long time. We've done investments, and our Asia footprint started in 2005 when we started the first office in Singapore, shortly after opened our office in Beijing, and then opened Tokyo, Seoul, now Hong Kong, and also Sydney. So we have now 6 offices overall. And I mean, Hong Kong still is the financial hub for Asia. It is one of the financial capitals of the world, and you see the energy. And, we want to be close to our clients, of course, that's very important, but also, doing fund investments, buying secondary portfolios. We also, in fact, did more than 20 direct private equity investments, usually co-investments, so minority investments alongside some other general partners in the region. But, I'm pleased with the growth that we've seen these past 12 months. It's above our expectation, and it will remain and even become one of the key offices for Ardian in the future. That's sure.
What about for private credit? Do you see there's a lot of interest still investing in that space, despite some pressure in some segments of the industry?
There's been some bad press there.
Yeah, exactly. I mean, there's a lot of noise about it, and you have to, or differentiate a bit between private credit in the Americas, in Europe, and Asia. What we're seeing, I mean, in Europe, really, the market is not as mature as in the Americas, but it is more mature than, let's say, in Asia. We have a credit fund where the loss ratio is 0.02% and the default ratio is 0.3%, so very low. And you need to be experienced in that market. We're doing this since more than 20 years. We've seen all cycles. We've seen the great financial crisis. Default rates in the Americas are a little bit bigger, but the market is also more mature.
Right.
And in Asia, it's a more it's a younger asset class, but we see a lot of demand, just to say that, because it is, it makes sense. There is a lot of demand for private credit. And when you really look into the quality of the underlying assets, of course, software has been a big topic. Yeah. But, there's winners and losers. And so clients globally, out of Asia, but also globally, there's still good interest for private credit, I can say, for sure.
Well, in terms of that, things like deal origination in Asia, specific markets that you think are growing faster than others, because structurally, we're more banked in Asia compared to, say, the U.S., right? So I guess that runway isn't as long, but just talk to us about how you look at markets and where growth is.
Yeah, you're totally right. I mean, in the United States, it started after the loans banking crisis and savings bank crisis. And in Europe, it really grew in the past 15, 20 years, while here it emerged more 5 to 10 years ago.
Right.
And sectors that we're seeing in Asia in private credit is that you finance mid-cap private equity firms, but of course also in infrastructure, real estate. And there is definitely good growth. I would expect high growth rates going forward out of Asia, out of Hong Kong, out of Singapore, and other markets.
You mentioned about when it came to the concerns around software and then, in the credits. I mean, have those concerns died? I mean, I don't know what the conversations are around that now.
Yeah. I mean, software, we really have to differentiate between software that is impacted and other software that's very integrated, where AI is not, not hindering the growth, but boosting it rather. So what happened on top is that some of these open-ended evergreen structures, were invested in private credit, and the combination of these two things, then, that was not a great combination. But if you look at closed-end private credit funds, they're doing very well. I mean, there are credit cycles, of course, you know, as always. So you'll see some higher default rates at certain times, but overall the asset class long-term growth we see still very high, and we're a big believer in the asset class.
Suffice to say, Jan, thank you so much for the time. Let's see you next time you're back in town.
Thank you so much for the time.
Fantastic.
Being here.
Hi to the team for us, please. Jan Philipp Schmitz there, Executive President at Ardian. Very quickly, though, just to mention, of course, in the last hour, we've seen, of course, a release of some data coming through out of China, and just some context coming through out of this National Bureau of Statistics briefing that's taken place, talking about the economy has solid conditions to achieve that annual growth target of 4.5% to about 5%. Of course, the latest growth number coming in slightly below the low end of that range.
Yeah, so they still have some confidence that they could get to that range by the end of the year, which I think this is what Zhang Zhiwei from Pinpoint did also say, right? It's reasonable, at least, despite a little bit of softness in the second quarter. Right now, they're saying the second quarter kind of remains stable, although growth has slowed. But certainly, it seems like overall, this set of June activity data did actually surprise the upside on certain prints. Right, take a look at retail sales with a 1% growth there, swinging back to positive territory. You see industrial production, which did surpass median estimates as well. So there were some bright spots in this set, really.
Okay, we will leave it there for now. In terms of market reaction, not a lot in as far as that one is concerned. A look at markets right now. So Asia is actually doing quite well in case you're joining us right now. We're getting a big lift coming through from the usual names in Korea and also in Taiwan. Chinese markets are also quite stable at the moment. Lots more ahead. This is the China Show.
Welcome back. You're watching the China Show. Well, Chinese memory chip maker CXMT is set for one of the biggest listings on Shanghai's star market and seeking to raise as much as $9.8 billion. The world's fourth largest DRAM producer has priced the offering at 866 renminbi a share. And the listing comes as Beijing pushes to build a domestic AI chip supply chain and challenge industry leaders, Samsung and SK Hynix.
Yeah, and analysts are saying that the recent sell-off that we have seen in Chinese AI hardware names, and the graphic is on your screens for you to see this up and then substantially down, is likely a transitory setback tied to, of course, disruptions when you get these massive listings, and then people then are looking to then fund hopeful allocations towards something this big. Let's get a take here from Winnie Xu, our Asia equities reporter, to talk us through this. Is this a rotation or a sign of, I guess, caution ahead of this big listing that's coming?
Yeah, so for now, we did hear that it's more of just a bit of a caution ahead of this big listing, because overall, the hardware space still looks quite sustainable in terms of how this long-term AI trade is playing out in China. But when you look at some of the historical trends, last year's IPOs, whether it's More Threads or Meta X, they actually saw, after their prospectus update towards their debut, we saw Star 50 falling, and that is because of some profit taking as investors really put in their bets ahead of the IPO towards it. And that's also what we saw so far this year. In the past 3 months, we're seeing hardware stocks really rallying. Star 50 up more than 50% or so into this debut as well. So right now, it's a bit of a profit taking as well.
Yeah, and so tell us a bit more about the momentum that we're seeing when it comes to the stock rally, right? It's very onshore. And people are saying the CXMT IPO could be the next catalyst here. What are people saying to you about how sustainable it is so far?
Yeah, so when it comes to the hardware space and the onshore, we heard from Goldman Sachs that they still prefer Asia just because of the AI exposure there. They're talking about how they don't see this AI equity rally to see a bubble just yet. And they're talking about earnings looking pretty sustainable sustainable. We had Giga Devices earnings the other day back, and it actually showed pretty positive results as well. So they see this trend to really continue. But when you also look at the other space when it comes to the offshore space, and those tech names actually looks to be quite sustainable as well. Morgan Stanley the other day also came out with a note saying that they expect this rally to go into August because of they see some more potential in the AI commercialization and how valuations remain quite cheap. So these big banks really still see how Chinese stocks likely going to gain more tailwind as investors rotate away from these outperformers in Asia.
Okay, Winnie, thank you so much. Winnie Xu there, our Asia equities reporter. More on this massive fundraising story that the overall theme of the show, of course, is, we talked about CXMT. The other big one, of course, is DeepSeek. And based on sources, they've actually told Bloomberg that the company is said to be laying the groundwork for an IPO with a filing, get this, possible as soon as this year. Now, sources say the company is working with the usual deal team, accounting firms, on its financials. It's targeting a debut possibly late this year or early of 2027. And we're told DeepSeek is also seeking fresh private funding that's ahead of that offering at a valuation of at least $71 billion.
Yeah, and if you look at the most recent fundraising round for DeepSeek, it's basically catapulted the founder, Liang Wenfen, to be the world's richest when you talk about the creators of AI models. So he's now worth $36 billion. Dave, that was up just from about $16.7 billion not too long ago.
Yeah, a few weeks ago.
And he's also surpassed the wealth of Anthropic's co-founder, Dario Amodei, and OpenAI's Greg Brockman as well. So there you go, catapulted to number one. Keep in mind, though, when we tallied and crunched the numbers, they took out some of the big tech names, right? Like the Alibabas and Tencents, because they're more diversified, not pure
AI plays, yeah. So I think as far as that group is concerned, if you put in Pony Ma, for example, I think Liang Wenfen comes in at number 9 in China. Only 36 billion gets you in the top 10, not quite in the top 5. That's based on the latest funding round. And of course, we'll see. Our understanding is there's a current, they still want to raise more money in private markets, and then who knows where this number goes when they actually list. I mean, you can just close your eyes and imagine that. You can rewatch our shows, of course, on the Bloomberg Video Hub. You can catch that, some of the segments you might have missed here. Of course, the breaking numbers coming through out of mainland China earlier on. And as far as the GDP numbers, the activity numbers are concerned, so that's on Bloomberg.com/videos.
All right, we're getting some lines crossing here from the president, and this is according to Axios. They're reporting that President Trump discussed wider scope of strikes on Iran. And this is after we just heard from just short moment ago, the U.S. Did talk about how they just finished another round of these strikes, right, and completed additional round of strikes against Iran not too long ago. So it looks like we don't see quite an end in sight when it comes to these latest flare-up in tensions. We have seen, of course, when it comes to the 20% levy, at least in the Strait of Hormuz, that has been taken away. President Trump really doing that U-turn overnight. But that blockade, that U.S. blockade remains in place at the moment. So, yes, that's why you're still seeing it. There's still a bit of uncertainty out there, and that's why oil markets are still perked up here this morning.
I mean, it's the worst of the two scenarios. I mean, would you rather a toll or, I mean, people would rather perhaps a toll because it's more predictable than, of course, the escalation between the actual two, which is, I think, the latest lines coming through here out of Axios here. And yes, to Yvonne's point, $86 right now in Brent. And yes, we are back above 80 also on West Texas. Just to pivot to the, I believe, still ongoing briefing. Yes, still ongoing briefing out of the National Bureau of Statistics on the release of the data this hour coming through out of China. Further context there, so this is important because they do expect CPI to continue to rise moderately is how they're using that. That goes into things like real rates, which we talked about earlier on. It goes into this GDP deflator, which I think we've managed to work out the math, not just yet, but yes, it goes into the growth numbers. Anything else you're seeing?
No, so I'm reading a T-Live blog, and they've been able to crunch the numbers. So despite that disappointing GDP growth reading, China appears to have broken out of this 3-year deflationary spell. The GDP deflator increased 1.6% from a year ago. That's according to our calculations based on this government data. So has it exit out of deflation? You know, that certainly could be a positive sign in some ways. So certainly that's one thing to watch very closely. We're watching some of these movers, in particular when it came to the property stocks. There was some movement there after that home price data. New home prices seems like the slowdown is slowing. Right,
the negative print is closer to zero.
Is closer to zero now, so that certainly is boosting the sector. It didn't really help the secondary market in the used home prices concern, but at least we are still seeing some signs of green there. Triple mini max, that's still one thing to watch, of course, given this whole kind of AI trade and where we are at the moment. You are seeing that rebound there after talks of DeepSeek and this IPO. That's spurring a lot of optimism in the space as well. Big tech like Tencent, Baba, Meituan, BYD are in focus as well. We're focusing on really what's been going on there. And there you go. HS Tech looking pretty good right now.
Okay, just an update, of course, of more important things. So the World Cup. So we now have the very interesting upset that took place. Upset because the French were, by and large, the clear favorites here. So Spain actually took it to.
Did you watch at 3 a.m. this morning?
I did manage to catch the latter part of it.
Oh, my God.
So I think
Before you went on your run this morning?
It was a very early penalty, and then I think they scored again early in the second half.
Okay. Argentina, England. What's your bet on that, David Ingles? Our football expert here, now that we have some time.
Well, so I couldn't believe... So Messi has played over 200 matches for Argentina. He's yet to actually play England. It's the first time he's playing England in his international career. And what's interesting is 40 years ago, 1986, Diego Maradona, of course, in Mexico, the famous, one of the best goals, if not the best goal you'll ever see in a World Cup, and of course the most controversial goal, which was the hand of God, was 40 years ago. So the plot lines around this one. And we were just talking about Jude Bellingham.
Oh, yeah. Yeah.
Fan favorite.
It's just speechless, really. Yeah. Hey, Jude. Hey. I want to be part of the crowd when he scores to sing Hey, Jude to him like they all do. And the fact that David Beckham also joined in, I mean, he's 23, right? I mean, gosh. The whole world's still ahead of him.
Sky's the limit.
Sky's
the limit. Okay, so anyway, this time tomorrow we'll be obsessing over the results of
These are old pictures, by the way.
Yeah.
We'll see what happens tomorrow.
It looks like they are singing Hey Jude. Okay, a very brief mention, the public service announcement. The weather in Hong Kong is becoming counterproductive. Amber rainstorm warning is up. That's it from us here. We'll see you all tomorrow. This is Bloomberg.